How high will Australian interest rates rise? That's the question that every property owner and prospective property buyer is asking right now. If you have a mortgage, this steep rate rise has made it incredibly difficult for you to service your variable rate loan. By contrast, if you're looking to go out and buy a home, these rate increases have made it much more difficult to convince a bank to lend you the money. Serviceability requirements have really started to bite. Indeed, Australia has had one of the steepest rate hike trajectories in history, rising from near zero rates to 3.6% at the time of recording. And this begs the question of how many more rate hikes are we likely to get? So let's start with what the RBA is saying about the economy and about what they're going to do, because that gives us the biggest clue about what the RBA is going to do with its cash rate going forward. In its latest statement, the RBA specifically said the following. In relation to its overall target, they stated, the board's priority is to return inflation to target, which is that 2 to 3% area. The board remains resolute in its determination to return inflation to target and will do whatever is necessary to achieve that. The board is seeking to return inflation to the 2 to 3% target range, while keeping the economy on an even keel. The board expects that further tightening of monetary policy will be needed to ensure that inflation returns to target, and that this period of high inflation is only temporary. So the RBA is clearly signaling that more rate hikes are possibly going to be necessary, potentially another 25 basis points or maybe 50 basis points, potentially even more. They're indicating they're resolute in getting inflation under control, and that is what their primary, potentially only target is at the moment, while trying to avoid a deep and major recession. The RBA then specifically talks about inflation, which is their primary target. The RBA specifically says, global inflation remains very high. In headline terms, it is moderating, although service price inflation remains elevated in many economies. It will be some time before inflation gets back to target rates. So here the RBA is largely talking about global inflation, that is inflation in the United States, the UK, and in Europe. And this is clearly important, because if inflation is incredibly high in the United States, the Federal Reserve will hike rates by more and keep them higher for longer. This is especially the case since many US mortgages are 30-year fixed-rate mortgages, meaning the US often needs to go even higher with its rates to get inflation under control. This then risks importing inflation into Australia, because when the US is increasing its own interest rates, that increases the cost of importing things from the United States, which then can import inflation back into Australia. And this, therefore, is going to concern the RBA. The RBA also makes some specific statements about inflation in Australia, specifically saying, the monthly CPI indicator suggests that inflation has peaked in Australia. Goods price inflation is expected to moderate over the months ahead due to both global developments and softer demand in Australia. And indeed, the RBA is correct here. Retail sales seem to be doing a little bit badly, and GDP came in below expectations. So suddenly there is some moderation of demand at the moment. They also state, service price inflation remains high, with strong demand for some services over the summer. Rents are increasing at the fastest rate in some years, with vacancy rates low in many parts of the country. Now, specifically on rents here, the RBA is correct that rents have increased significantly and that vacancy rates are very low. In some major capital cities, particularly in the CBD area, rents are, however, just recovering back from their pandemic lows. After all, during COVID, many people had significant rent discounts, both of residential and commercial property. At the moment, we're seeing rents readjust back toward near what they were before COVID. So to some extent, this steep rent inflation that we're seeing is largely just a rebalancing back toward what things were before the pandemic hit. The RBA also states, the central forecast is for inflation to decline this year in 2023 and next year 2024, to be around 3% in mid-2025. Medium-term inflation expectations remain well anchored, and it is important that this remains to be the case. When they're saying medium-term inflation expectations being well anchored, what they mean is people's expectations about what future inflation will be. That's important because if people expect inflation to be incredibly high, they're going to go out and spend more money now, because present money is going to be worth more to them than holding on to it into the future. So they're going to have an incentive to spend it right now. And this would then exacerbate inflation. That is, it ends up creating a vicious cycle. So ensuring that inflation expectations are well anchored is in fact important, like the RBA is saying. The RBA also talks specifically about growth. The RBA states, growth in the Australian economy has slowed, with GDP increasing by 0.5% in the December quarter and 2.7% over the year. Growth over the next couple of years is expected to be below trend. And indeed, the RBA is correct here. GDP was a little bit underwhelming in December, coming in below expectations. This suggests that on the one hand, inflation remains quite high, although they're suggesting it might have peaked, but growth is going back down. Now, if indeed inflation has peaked and is going to start attenuating, and we're going to go into disinflation, and growth is moderating, that is actually probably good news for the RBA and good news for rate expectations. The RBA also specifically addresses the labour market, stating, the labour market remains very tight, although conditions have eased a little. The unemployment rate remains close to a 50-year low. Many firms continue to experience difficulty hiring workers, although some report a recent easing in labour shortages. As economic growth slows, unemployment is expected to increase. Now, the focus on employment here is important, because if unemployment is incredibly low, that creates more wage price pressure, which could potentially trigger a wage price spiral. Although the RBA does note that we don't seem to be heading into a wage price spiral right at the moment. The RBA also talks about risk factors that could moderate what they're doing with interest rates going forward. The RBA specifically highlights large global uncertainty, stating the RBA recognizes that monetary policy operates with a lag, and the full effect of the cumulative increase in interest rates is yet to be felt in mortgage payments. And indeed, that is correct. Many people are going to be going on to variable rates later on in 2023 into 2024. So for many people, that mortgage rate cliff is yet to be felt, but will come at some point in time. The RBA is right to note that the actual effect of all of these steep rate hikes is yet to be seen for many people. The RBA should, however, be cognizant that if they leave it for rate hikes to really bite into that number of people, particularly if we've got a declining growth in the economy, that could create quite a lot of economic damage. So they really do need to be very careful if they were to continue on hiking rates. The RBA also states there is uncertainty around the timing and extent of the slowdown in household spending. Another source of uncertainty is how the global economy responds to the large and rapid increase in interest rates around the world. These uncertainties mean that there are a range of possible scenarios for the Australian economy. So if we wrap up what the RBA itself is saying, they're basically saying inflation is very high, it's much higher than they want it to be, but there appears to be some disinflation in the economy. Growth appears to be slowing. However, it hasn't slowed that much at the moment, and the labour market is quite tight, and they are monitoring whether there is going to be a wage price spiral. This means that the RBA has more work to do to get inflation under control. This suggests the RBA is going to need to do more hikes, take rates up from the 3.6% even higher, maybe toward 3.85 or 4.1%. So the RBA has clearly signalled there are going to be more rate hikes going forward. The next question is then, how many more rate hikes are we going to get, and what is the terminal rate likely to be? Well, here we are crystal ball gazing. As the RBA has specifically said, there's a lot of risk factors that can come into play. For example, what goes on with the reopening in China? Does China's economy actually genuinely progress significantly in 2023, or is China stuck back with GDP growth of 3% that they experienced in 2022? What's going on with Russia and Ukraine, and how does that affect commodity prices? What does the Federal Reserve need to do, and what's happening with inflation in the United States? Many factors can feed into what is going on in Australia, and therefore what the RBA ultimately needs to do. But we can discern some things. First, the RBA has clearly signalled that at least one more rate hike is going to be necessary. They've specifically flagged this because they've flagged that inflation is far too high and that they need to do more, and that more tightening of monetary policy is going to be necessary. This suggests at least one more rate hike. But if we look at the fact that inflation at that time was above 7% of the latest prior reading, and this is the time where they signalled more rate hikes are going to be necessary, this suggests that even more than one rate hike is going to be required. That is, not just 25 basis points, at least 50 basis points. We can also see what economists and major banks are predicting. And the banks are suggesting that the RBA will likely take its cash rate to 4.1%. And this is likely to occur by Q3 of 2023. However, it could occur a little bit earlier if the RBA decides to be significantly more aggressive. But nevertheless, we are going to see at least another 2 rate hikes. And this is going to occur during the first half through to Q3 of 2023. There are some predictions that the RBA might cut rates toward the end of 2023, potentially cutting them quite significantly in 2024, or if not 2024, 2025. Now what this suggests is that there could potentially be some light at the end of the tunnel. Now the rate cuts are likely to reflect a few factors. Firstly, they reflect declining economic growth, But secondly, they'd reflect the fact that many people are highly indebted, will be going onto variable rate mortgages, and these variable rate mortgages are going to be very difficult to service as these newly much higher rates. And this would suggest a significant hit to consumer sales and then a significant hit to economic growth, suggesting that rate cuts are likely to be necessary. Now, in terms of how many more we actually get, like I've indicated, the banks are suggesting maybe another 2 rate hikes, going from 3.6% up to 4.1% as the terminal rate for the cash rate. Now, this is largely reflecting both A, the need to get inflation under control, B, the fact that in Australia, mortgage rates are often variable mortgage rates, and therefore for many people, rate hikes immediately hit their ability to go out and spend money. And if they're not being immediately hit, they soon will be. Hence why they might not need to go even more aggressively than just another 50 basis points in total. And therefore, we're likely to see another couple of rate hikes. The reason we wouldn't see more rate hikes is due to the significant damage that would likely wreak upon the economy. The reason we're unlikely to see fewer rate hikes is another 25 basis points might be seen as a little bit too dovish, and that might risk inflation expectations getting unanchored. So it might be seen as if the RBA is not doing enough, not being hawkish enough to get inflation under control. The RBA had clearly been scarred by being too dovish earlier on, and is going to be trying to do whatever it can to get inflation under control. Furthermore, the RBA has a clear incentive to herd. That is, they were so wrong in the past, or at least their rhetoric was so wrong, that they don't want to be seen to be wrong going forward. And even if they are wrong, they would rather be wrong with every other central bank as well. We seem to be likely to see a terminal rate of around 4.1%, so a couple more rate hikes. If you've got any thoughts about what's going on with these rates, whether you think the RBA is going to go higher or lower than that 4.1%, let me know that in the comments below. And otherwise, don't forget to subscribe, and hopefully I see you next time as well.